firm. And we are very much excited to have you join us for this special webinar where we will be going over how things went in 2023 and what are some of our thoughts as we get into 2024. And so we're really excited to be able to present this and hope you're all able to benefit from the content. So without further ado, we're going to dive right in, and Naushad Virji will be covering the first section, where he'll be going over mostly our value models as well as our passive strategies and some of his thoughts on the markets. And then I will be examining the growth models and also sharing some of my thoughts overall. So thank you once again for tuning in on this Wednesday evening. We appreciate you joining us and we look forward to your participation. Naushad, you can take it from here.
All right, fantastic. Assalamu alaikum, everybody. I hope everybody can hear me. Aliredha, can you guys see the screen?
Yes, we can see the screen. I think right now it's gray, but if you go to the next, hopefully we can start to see the slides. We're seeing a gray background.
Let's see. It says that it's paused. Let me. Okay. It says that it's sharing, so hopefully you can see the screen now.
I'm still seeing just a gray background. It was showing us your slides, but now it's showing me a gray.
All right, let me try this again. All right, can you guys see the title page?
Yes.
All right, fantastic. So you should be seeing the first page of the presentation, annual report and outlook.
We are seeing also the next slide and presenter notes right now.
Oh, okay. I am not sure how to.
I think at the top there, Naushad, you see where it says display settings at the top of left? Click that, and one of the choices there should be the one that you need, because it's gray now. I can't see, but the top.
Yeah, it's not letting me. It's not letting me choose anything from there. Anyway, I think what I'm going to do, just for sake of simplicity, is maybe just run this. Let's see, just run it full screen. That might just be easier.
Yeah.
All right.
Perfect.
All right, you guys got it?
Yep.
All right, fantastic. All right, so I'll introduce myself first. I'm Naushad Virji. I'm the founder of ShariaPortfolio. I'm also the CEO of SP Funds, ShariaPortfolio Canada, and ShariaPortfolio Global. And for the US company, I am the portfolio manager that has been running the value models since 2003. So it's been a little over 20 years. And it's been a really exciting journey. We've had a lot of ups and downs, a lot of different market cycles throughout that time. So when you're invested in the value models, you're basically in a tried and tested strategy that's been going on for quite some time. I personally oversee about 700 million in assets under management through our funds, as well as portfolios that I personally manage. So I have been doing this for a while, and I appreciate everyone joining us today. I'm going to focus a lot of my discussion on the value models, and then I'll defer the growth discussion to Aliredha. So We'll start off with a disclaimer. I am not offering investment advice, or we're not offering investment advice in this presentation. If anyone is interested in investment advice, they should contact one of our financial advisors and have a one-on-one discussion to discuss their personal situation and their personal needs, and they'll be happy to help you in that one-on-one setting. This is for information only. We are going to talk about some investment results, and there's also, we're going to discuss our net of fees. And of course, past performance is no guarantee of future results. Today's agenda is going to have 4 distinct sections for my presentation. We're going to start off with talking about what our investment offerings are. This is a little bit of a recap. We did the same thing last year, but I think it's important to make sure everyone understands all of the different offerings that ShariaPortfolio has. And then we'll kind of go into a discussion about what happened in 2023 and talk about the results for each of our models. After that, I want to talk a little bit about the value models specifically and what they look like, and share with you the actual construction of these portfolios, and talk about that just briefly, and then go on to my expectations and forecasts for 2024. And then after all of this, we'll do it again for our growth models, and Aliredha will take over. So let's go ahead and dive in. First of all, we have 2 major investment styles. We've got passive strategies and active strategies. And there are a lot of firms, like maybe robo-advisors, for example, that'll offer a passive strategy to their clients. There's other wealth management firms that only focus on active strategies. We're really proud to be able to offer both of these to our clients, because I think both of them are really important and relevant based on different situations. You know, every client has their unique needs, their unique preferences, their suitability, long-term goals, short-term goals. And so it may be that for some accounts, a passive strategy might be the way to go. And for others, an active strategy might be the way to go. Just to differentiate what this means, a passive strategy means we're focusing mostly on ETFs. So we're just going to have ETFs in the portfolio, which helps decrease risk, because each ETF has hundreds of stocks. So instead of focusing on 1 or 2 or 5 or 10 stocks, you've got a basket full of stocks that could be, our SPWO is going to have about 500 stocks in it, just to give you an example. So it's pretty well diversified, and that's how it decreases risk. It's also lower cost, because if you're in a fund, you're paying a lower expense ratio and a lower management fee from us, because it's less work for us. This is more of a buy and hold type strategy, and it's suitable for smaller investors or those with a much lower risk appetite. And we have 6 different investment strategies to choose from in the passive space, and I'll show you more about that later. Going over to active. In the active models, we focus on individual stocks, and we also offer a lot more personalization, things like tax loss harvesting, tactical maneuvering, depending on what's happening in the markets. This type of strategy is much more suitable for those wanting to maximize long-term returns with tax efficiency as well. So having something, having an active strategy is kind of like having a tailored suit, whereas a passive strategy might be more of an off-the-shelf type product. Both, it's not that one is better than the other. They're both appropriate for different types of investors, and depending on what you're trying to achieve, one may be better than the other, or it might be good to have both in your various portfolios. This is something your financial advisor can help you ascertain. Now, within the active investment space, now looking at the active approach or the active style, we actually have 2 different approaches to active management. We have the value approach and we have the growth approach. So with value, we're really focused on trying to buy companies that are trading below what they're worth. So value investing is kind of like how you might buy groceries. You know, when you go to the grocery store and milk is on sale, you might come home with 2 gallons. If you go another day and it's twice the price, you might come back with orange juice instead or something else. So that's kind of how we look at buying companies when it comes to value investing. We want to get a good deal. One of the advantages of value investing is that it does tend to be a little bit lower risk than growth investing. The reason for that is that we're buying stocks that are already trading at a pretty good discount. So there's less room for them to go down. This type of approach is really suitable for investors who are looking for more stable returns over time. As I mentioned earlier, I've been running these value models for over 20 years now, so we do have a long history. However, we have the growth models as well, which are designed for people who really want to focus on innovation and high growth investing or high growth companies. Though we don't have as long of a history with growth investing, the returns have been really impressive, especially in 2023. The potential to outperform the market over time can be very impressive with growth. It can offer higher potential returns over time. And this type of investing style is suitable for investors who are comfortable with more volatility, but possibly higher long-term returns. One of the ways that we differentiate these two is via the benchmark. So when it comes to value investing, our target is really to try and achieve returns that are in line or better than the S&P 500. The S&P 500 is a broad swath of the market. So you have all kinds of different companies, 500 of the biggest companies in the US. And so that makes up the S&P 500. And our goal is really to try and mimic those returns, or maybe do a little bit better than those returns, or at least perform in line with those returns. With growth, the focus is more on beating the NASDAQ, or at least being in line with the NASDAQ. For people who've been paying attention to the markets, you probably already know the S&P 500 does about 10% a year. That's the historical average for the last 50 years or so. With the NASDAQ, the average annual return is around 16% a year. So people who are trying to get that extra alpha, growth might help you achieve that, but you also have to realize that it could be a roller coaster ride. It's not going to be necessarily a straight line. So we're now within all of those different styles and approaches that I just mentioned. We have different strategies for each of those. So we have aggressive growth, moderate income, and conservative for both active value and active growth models. For our passive strategies, we have all 5 of those as well, plus Sukuk. And the slide we're looking at right now kind of gives you an idea of how that's made up. So aggressive, for example, will be about 90% equity, meaning stocks. And we might have about 5% in Sukuk and 5% in real estate. As you get a little bit more conservative, let's take a look at the conservative model here. We're now 70% Sukuk, 10% real estate, and only 20% stocks. So there's obviously a big change. If you're in conservative, your focus is more on capital preservation. It's more about making sure you don't lose money. Whereas with aggressive, we're more focused on trying to make you as much money as we possibly can. So this breakdown here gives you a little bit of an idea of how we're allocated between stocks, real estate, and Sukuk. And for those who don't know, Sukuk are effectively the Sharia compliant alternative to fixed income bonds. Sukuk you can think of more as kind of like a lease to own type thing versus buying or getting a loan from a bank. So there's a lot more to it, and we could do a whole seminar on just what Sukuk is. But effectively, you could just think of it as an Islamic bond. Now, section 2, we're going to go on to the market overview and results. So what happened in 2023, and how did these models that I just talked about do? Before I answer that, let's take a look at how the S&P 500 itself did. So the chart we're looking at now is the S&P 500, and these are the total returns. Most people are probably hearing in the news about the price returns being 24.23%. The chart I'm putting up is the actual total returns, which basically just includes dividends. So when I'm talking about how our models have done, I'm going to be giving you the returns with dividends. So it's only fair that when we're talking about the S&P 500, we should include dividends there as well. So in 2023, you can see that the first half of the year, we had a nice run up and then a little bit of a pullback in Q3, and then November and December resumed that stellar rise upwards. So at the end of the day, for 2023, the S&P 500 had a gain of 26.44%. Now let's take a look at how Sharia investing, or the Sharia 500, as I like to call it, did in comparison to the S&P 500. I'm using SPUS, which is our Sharia compliant ETF. SPUS is effectively all of the all of the S&P 500 stocks minus anything that's not Sharia compliant. So that leaves about 200 stocks in SPUS versus 500 in the S&P 500. So those 200 had a pretty good year last year. We had a return of about 34.23% in the Sharia 500. So the Sharia stocks in the S&P 500 outperformed the S&P 500 by about 8% or so. So not a bad year overall. But now let's talk about the NASDAQ. NASDAQ is where our focus is more on innovation and technology. And the NASDAQ had an even more phenomenal return last year of 44.7%. So it outperformed the Sharia 500 and the S&P 500 last year. All three had great returns. I'm not knocking the returns of any one of these. I think they all did phenomenal. But this gives a pretty good perspective on how the year went for these different indexes. So let's talk about how our investments did. Starting in the top right here, you can see the different indexes. So we just covered the S&P 500, the Sharia 500. And then in addition to that, you can see what Sukuk did. It had a modest 3.95% return for the year. And real estate, Sharia compliant real estate anyway, as represented by SPRE, was up 9.34%. So these indexes kind of give you an idea of how the different areas of the market performed. It's no big surprise that SPSK was a little bit lower given what's happened with bonds in general. But nevertheless, these are good indicators to give you an idea of various parts of the market. Now let's take a look at our passive styles. Running through these quickly, aggressive did about 23.3%, and then growth was down to 20.17%, moderates at 15.61, income's at 10.49, conservative is at 7.14, and Sukuk is at 5.11. These are all really good returns. Our Sukuk strategy, when you look at 5%, you may be less impressed, but our focus with Sukuk is on capital preservation. So when we're looking at aggressive, we're trying to make money. When we're looking at conservative and Sukuk, our focus is on not losing money. So you have to put that into perspective. So this is how our passive strategies did in 2023. Now, when we look at the active value portfolios, we did a little bit better on our aggressive. We had a 27.89% return versus 23 in passive. So last year, when we had this same discussion, I had predicted that I think active investing is going to start to outperform passive. And with our aggressive, we certainly did. And I think that that's a trend that will probably continue, especially since interest rates are higher now. And the reason why interest rates are important, even though we don't deal in riba or not investing in riba, riba doesn't impact the markets because a lot of companies that have debt, especially companies that have a lot of debt, their expenses are now going up. So that interest expense matters at the end of the day. So even if you're growing, even if you're making more money, if your debt is causing you more expenses, at the end of the day, your net is not going to look so impressive. And with passive style investments, we don't really have much control over that. We're just invested throughout the market. With active models, we're able to pick and choose, and that's where things become a little more interesting, and we're able to make more tactical decisions that can help us outperform. And speaking of outperformance, our active growth models had a phenomenal year. So anyone who was lamenting the prior year can be rejoicing about 2023 with an aggressive growth return of 73.26%. Yeah, you heard that correctly. It's 73.26%. Growth was up 61.53%, and then the moderate strategy was up 48.9%. So 2023 was a really great year all around for all of our models. Now, one of the things that's really important for clients to understand is that when we're buying stocks, one of the very important considerations for us is sectors, and sector allocation. So after this discussion we just had of how all these different models did, it's important to take a look at within the S&P 500, what happened. You can see that technology led the charge upwards with 56.39% gains, followed by communication services, which are companies like Google and Meta, up 54.36%. And then followed by consumer discretionary, companies like Tesla, were up 41%. So just those three alone are effectively the definition of what you look for in a growth type model. So when you look at how well growth did, these are the things that really helped contribute to that. And when we're buying stocks, when we're deciding what to buy, one of the things that clients should understand is that it's not an arbitrary decision. We look at what the benchmarks have in them, and then we try to buy maybe a little bit more, a little bit less, depending on whether we're bullish or bearish on the particular sector. Like, let's just take healthcare, for example. Healthcare didn't have such a great year last year, where it was only up 0.3%. Now, as a value investor, for me personally, I feel like that means there's probably some opportunity in healthcare. So I'm going to look at, how much does the S&P have in healthcare overall, because that's my benchmark. Hypothetically, the S&P might have, say, 20% in healthcare. So if I'm bullish on healthcare, I might want to go 25% allocation to healthcare. If I'm bearish, on the other hand, I might just do 10 or 15% in healthcare. But that's how we decide where we're going to invest. And then it's up to the particular portfolio manager to decide now which stocks in that sector we're buying. So this whole thing could be a whole discussion, hour-long discussion in and of itself on how we're picking certain stocks, but I just wanted to kind of give you a quick overview on the sector allocations, and particularly the sector performance and how each one of them did last year, what really contributed to our gains. So section 3 is going to be passive and value models. We're going to discuss those particular sets of models and what comprised them and what happened in those areas. First of all, when we look at the overall market performance, 2023 was a very big year of resilience, where even though we had rising interest rates, even though we had major inflation concerns, and even though there were some serious geopolitical tensions, the S&P 500 still achieved a return of 26% last year, exceeding its historical averages. So even with all of these headwinds, the S&P still held up very well. And the positive performance, in my opinion, can be attributed to a few different factors. First of all, strong corporate profits. Businesses have largely adapted to inflationary pressures and maintained profitability, exceeding expectations. So effectively, what I was saying about higher interest rates on affecting a lot of different companies, I don't think we've really seen that fully through yet, but it didn't really play a big part in last year's numbers. Our businesses in general adapted and did really well, and we saw strong corporate profits. The Federal Reserve policies, where they raised interest rates, they really need to pat themselves on the back because they ended up doing this without hindering the economic activity or the markets last year. There was a lot of concern about, well, if we're going to raise our rates this quickly, what's it going to do to the market? The answer for 2023 was really not much. So they did a good job and managed to balance things out and gave us a really good environment to outperform. Investors at this point are a little bit cautiously optimistic about the possibility of a soft landing for the economy. At this stage, I think most people will say that we probably are going to have a soft landing. We're not going to have a major recession. The Fed did a good job. The economy has been resilient, and we're on a really good track. So these are the factors that I think really helped us in 2023. In the passive models, this is kind of a x-ray of what our passive models look like at the turn of the year. So you can kind of see how we're allocated. As you can see in aggressive, we're at 92.5% are in equities. By equities, that means real estate, it means stocks, it means technology, it also means international. Personally, I think that there's a lot of opportunities in the international markets. The US market has had a pretty decent run for the last decade or so. International markets have not done quite as well. And I think that this is an area that I really want to see more focus on in 2024. And so we've done that by introducing SPWO into our portfolios. And that's going to give us a lot more exposure to international. With aggressive, we're also introducing more technology through SPTE. So SPUS gave us a really good exposure to the market in general, but SPTE will allow us to have a little bit more exposure to things like AI, innovation, technology, and global technology at that. So not only will we have the typical Apple, Microsoft, Google, and some of those type of stocks, but we'll also be able to have Taiwan Semiconductor. We'll have stocks like Alibaba and stocks from throughout China, India, and other developing areas. So SPT will really give us, some pretty good exposure to some of these other areas as well. And if we have another good year with technology and innovation, then we'll see a little more of that flow through to our passive models. In our active portfolios, this might look a little bit more daunting, but we have a lot more focus on individual stocks with our active models. And as you can see here, some of the technology names that have really helped us are companies like Adobe, Taiwan Semi, Tesla, had a big impact last year, Encore Wire. I can talk about a lot of these in detail, but the main reason I wanted to put this up was just to give you an idea of what the makeup of our portfolios, our value models looks like, just to give you an idea of how we're controlling volatility, sector allocations, and the type of stocks that we're investing in. This is what the sector allocation looks like. And the important thing here, the slide on the left should actually say 2023. The slide on the left side is the aggressive January 2023 allocation versus the January 2024 allocation. So one of the differences you can see is that we focused a lot more on technology. And again, that was one of the things that really helped us outperform in a year where technology was fairly unstoppable. So you can see how we adapt to the environment, how we adapt to what's happening in a changing market. And these allocations will give you kind of a good idea of how you're invested. The type of stocks that we put into the value models just to kind of run through these really quickly. And this, by the way, is where we were at the turn of the year. So technology, our main technology stocks are Adobe, Salesforce, Qualcomm, and Taiwan Semiconductor. Um, all of these stocks have been phenomenal last year, and I believe they're going to continue to be. A lot of professional portfolio managers are crazy about Salesforce right now. That's been one of the ones that's been talked about a lot. We have it directly, but we also have it through SPTE. So we do have some pretty good exposure to great companies like Salesforce. In energy, ExxonMobil has been our main choice, mainly because of the high dividend yield. As you can see, energy didn't have the best year last year. So going with a name like Exxon kind of helps protect us versus being overexposed to energy or buying small or mid-cap stocks in the energy space. What we do this year will remains to be seen, but we're starting off with Exxon in the portfolio. Healthcare wise, we have Amphastar, which makes drugs, generic drugs that are typically inhaled. So things for asthma as well as for blood sugar control. Blood sugar is a big one, especially with the way healthcare is these days and obesity. I believe Amphastar will be a decent holding, although it has been a little bit shaky. Becton Dickinson is one of our newer holdings. If you've ever had to go for blood work, you probably got familiar with Becton Dickinson because they make a lot of the needles that are used for that. So I don't see that going away anytime soon. J&J is a premier healthcare name, especially after a year like last year where healthcare didn't do as well. I think that J&J will be a phenomenal holding for this year. And it's another one that most financial professionals love. My main industrial pick has been Encore Wire, mainly because we need wiring, whether you're making EVs, whether you're making computers, whether you're building homes or commercial buildings. Wire is more important than ever because we're living in a more connected world. We're using more microchips than ever, even when building a car. And so my view is that wiring is going to be even more important than it's been. This has been one of the best stocks in our portfolio with an average annual return of like 50% a year over the last 3 years. So it's been a good holding and inshallah will continue to be. Consumer discretionary, this is an area where I get a lot of questions from clients, why the heck are we buying Best Buy? Aren't they gonna go away because of Amazon? Well, my question to you, I guess I can tell you my own personal experience. I bought a TV from Amazon a couple of years ago and I had no idea what I was doing. I don't really know that much about TVs. I got what I thought was going to be an amazing TV, horrible picture quality. I really just picked a dud. I ended up going to Best Buy and talking to people who actually know what they're doing. And they helped me decide what TV I should have. And they even matched Amazon's price and gave me a phenomenal deal. And I don't think that that's going away. Maybe, online, maybe the way things are headed, but that same is true for Best Buy. At this point, 40% of their sales are online. So having that brick and mortar combo with the online storefront, I think is going to be phenomenal. And on top of that, Best Buy is up about 14 or 15% since we bought it 2 months ago. So I have no complaints about Best Buy. Green Brick Partners, I think, is a stock that's done exceptionally well in real estate. And I do think we'll have a little bit more of a comeback in real estate. So we'll see how Green Brick does, but I think it's a good holding for us. Tesla is a holding I've had for a really long time. I think when I first started buying Tesla, it was long before most people were familiar with Tesla. And it's just been one that I've continued to hold, but I have scaled back. So I used some of the proceeds from the gains we've made with Tesla to buy some of these other stocks. And we'll see how things continue with Tesla. I think Tesla is really great for growth models, for value models these days. It's not as front and center as it used to be. Precious metals wise, we do have some gold, mainly for capital preservation. So in income and conservative models, you'll see a little bit of gold, but we're not really using that much elsewhere. Basic materials, this is an area that has not gone so well for me. My main holding is Sociedad Química y Minera de Chile. I hope I'm saying that right. We call it SQM for short, which is its ticker symbol. This is one of the world's biggest lithium suppliers. And the thesis for buying this stock was that as EVs continue to take off, you're going to just need more and more lithium. And most of the lithium in North America does come from Chile. So it made sense that this should be a good holding. However, we've run into a couple of major issues with SQM. One is that a lot of lithium has been found in Wyoming all of a sudden. So now we may end up getting more and more lithium within the US versus having to import it. Another big issue is that the government of Chile was so impressed with SQM and how well it's done that they're nationalizing part of the company. So that obviously doesn't help our case. So we haven't done phenomenally well with SQM, but it is a small holding. And unless EVs are going away, lithium is still going to be important. And so it's one of the ones that I'd like to hang on to for now. Our main communication stock has been Juniper Networks. If you've been following the news, HP just announced that they're going to acquire Juniper at $40 a share, which is about 30% higher than our purchase price. So we're effectively cashing in on this stock. One of the beautiful things about value investing is that this happens quite often because our parameters for buying value stocks happen to be the same if you're acquiring a whole company. So it's not uncommon. We've had this happen pretty routinely in value models where one of our stocks is being acquired by someone else. I think last year or maybe the year before was Twitter. We've had quite a few companies where this has happened, but it's just a big gain for us in our model. And now I got to look for another communication stock, but alhamdulillah, we did well with that. And our consumer defensive stock is CalMain. Consumer defensive is important when you're worried about volatility. The reason I like CalMain is that I believe no matter what happens in the markets, you're probably still going to want to have breakfast. CalMain is the largest producer of eggs in the US, and the stock has done pretty well the last few months, and I expect more from CalMain, and it has become, a bigger holding in our value models. So we'll stay tuned and see how things work out. I went through those stocks pretty quickly. Anyone who has a value model portfolio with us, feel free to book a portfolio review and we can discuss it, these stocks or anything else that's on your mind in more detail. Now I'm going to go into our last section, or at least my last section, and that is the expectations and forecasts for 2024. First off, some of the key trends, the market experienced some significant growth last year in the first half of 2023, especially, and then what we saw in November and December. The Federal Reserve managed to keep inflation under control. It still remains a concern, but it's less of a concern than it was a year ago or 6 months ago. Geopolitical uncertainty, we still have some geopolitical concerns. However, it really hasn't derailed the market's trajectory, and we hope things will continue to be stable, and we hope that a lot of the geopolitical issues that are out there start to calm down, and inshallah, a lot of the people who are really suffering overseas will be in better shape soon. Market leadership, the tech plus sector, which is basically technology innovation, has driven returns. And if that continues, I think we're pretty well positioned to continue to benefit from that. There are some signs of sector rotation now. Investors are increasingly exploring undervalued sectors like energy and materials, areas we just talked about earlier. And that's something that I'll be digging into a little bit more this year as well, because I do think that there's a lot of opportunity in value, particularly because of the disparity between the Magnificent Seven and everything else. So let's talk about that now. First of all, the Federal Reserve accomplished its goal with a Goldilocks scenario in 2023, which basically means price growth slowed. So inflation slowed without hurting the economy. The concern that I have is this disparity between the Magnificent Seven stocks and everything else. I believe that there may be some shifting back to normal multiples. And I think value opportunities should be plentiful as a result of this disparity. So that means my job should be pretty fun this year because there should be a lot of opportunities with value stocks. I also think that there are going to be great opportunities internationally in the developed and developing world. I feel so strongly about that we just launched SPWO last month as an ETF that invests in these two areas, in both developing and developed. So it's all ex-US investments. And I really think that there's some tremendous opportunities in the international space, and SPWO is how we're going to capitalize on that. Economists have predicted a slowdown in the US economy. We'll see how that pans out. I have heard people like JP Morgan's Jason Hunter, who doesn't believe we'll have a recession, but he's thinking we're going to retest the S&P lows at 3,500. Let's hope that doesn't happen, but we have to be aware that there's a possibility. We have other analysts like Goldman Sachs' David Kostin, who expects some modest upside given that the markets are relatively high. However, he's expecting that most companies will likely see 5% revenue growth. Part of the reason why that number might be lower is what I mentioned earlier about interest expense for a lot of companies that have debt. So, I think we're still hopeful for a soft landing, but we have to just be careful because it's one thing to make money, it's another to not lose money. So that's my take on the markets, and I think I might have gone a little over time. I apologize, Aliredha, but there was a lot to cover, and I'll go ahead and turn it over to you with that.
All right, thank you, Naushad. I'll go ahead and share my screen here so we can get this going and try and make sure that everything's working. All right, do you guys see my full screen? Are we good?
Yes, I see it.
All right, fabulous. So I'm gonna try and zoom in a little bit into some of these different growth strategies that we have, as you've already kind of got an idea of how things went with the value and the passive strategies. So I'm gonna get into a little bit of the macro and then also the individual holdings on some level and kind of the expectations as well. So, coming into 2023, a lot of people were really concerned because, it was a pretty big drawdown in 2022, and people were expecting that maybe 2023 will be another negative year. So looking back at the data from 1928, so looking a longer time frame, there were only 4 times that we saw consecutive back-to-back negative years. So the odds were in favor of a positive 2023, just from the fact that 2022 was a poor year. And that was kind of how I was seeing the potential opportunities that we were able to take advantage of as the year started in 2023. In addition, you've probably heard of the first 5 days. If the first 5 trading days of the year are positive, which was the case in 2023, 80% of the time, the market tends to do well for the rest of the year. So that was another kind of data point that helped us to kind of see how things were going to go. But we'll talk more about that in a bit. You've all heard how we did, so I'm not going to go too much in there. Very grateful for how the markets were and the opportunities we were able to capitalize on. And we hope that this trend can continue as we go forward. Overall, if you look at the trends in terms of how different ETFs performed, you can see here the technology NASDAQ, the QQQ is not necessarily the NASDAQ that Naushad was talking about. That is the NASDAQ composite. But if you look at just the top 100 companies, they're more tech heavy. That was up 54%. Other notable things in there, technology sector, communication services were the top performers. Consumer discretionary also did quite well. And that, we're hoping could also continue as we go forward. Also, you can see some of the data for the other countries and, Australia and Brazil, especially Brazil, did quite well. And Mexico and Spain also kind of are notable in that category. So we like to keep an eye on all of this as we go forward. So you've heard a little bit about Magnificent Seven. They definitely played a big role, and they contributed to a bump of about 75% in 2023. Now, if we did not have the Magnificent Seven and someone was only investing in the rest of the 493 companies of the S&P, they would have been up only about 12%. And the S&P itself, as you know, was up about 24%. So I think that being selective in some of these winning names is very important. And we've definitely seen how missing out on some of these could mean missing out on some of the big gains. And so this is just something to keep in mind. Also, a lot of people were concerned, should we wait until the Fed has changed their course with regards to cutting rates? Now, in the 1982 analog, we can see that as the Fed kept raising rates, people were concerned, when is the change, when are things going to shift? But even throughout the rising rates environment, if someone kept investing, even despite the drawdown of 27% that took place, the Fed didn't shift their course in terms of when they were going to start cutting rates. But that happened much later. And for those who decided to stay through that process, which is kind of what 2023 was representing as well on some level, because it wasn't up until July of 2023 when the Fed decided to pause the rate hikes. And it was until December when they decided, hey, we're going to now possibly start cutting rates in 2024. So, by waiting for the Fed to announce when they're going to cut rates, you're potentially leaving a lot of the gains on the table. So this is why I tell folks, don't necessarily wait for the Fed. And if there is an opportunity, valuation-wise or, looking at the individual holdings, things, make sense to be in the markets, and missing some of the key days, you could potentially miss some big gains. Next, I'm going to quickly look at what is expected as we go forward. The market is expecting that the Fed is talking of 3 rate cuts. The market probably is expecting a little bit more. And we are also in an election year, so it's possible that the Fed is not going to be as hawkish. And the dot plot that is currently out there shows that we could be touching 3% by 2025, but at least about 4% by the end of this year. So that would be positive for borrowing more. If the rates are lower, that spurs economic activity. And on the right-hand side, what you can see here is that if we are able to avoid a recession, then after the first rate cut, which at present is projected to happen in March of this year, then the performance of the S&P tends to be very positive. So if, again, assuming no recession, which a lot of economists and other analysts believe is probably the case this year, there probably is more stimulus coming our way, then the opportunity to see gains is usually there, and hopefully that trend plays out based on historical data. Naushad has already talked about the opportunity for emerging markets. You can see historically the US has done quite well, and maybe there is an opportunity in the next decade or so, especially as growth and their GDP of other countries such as in India, China, Vietnam, among others, are showing a lot of growth in their in the Latin America countries as well. We could see that their equity performance start picking up. So things happen in cycles. The US has had a good run. That doesn't mean the wind is going to be out of the US holdings anytime soon. It just means that valuations are much lower, and that usually could present some good buying opportunities, as Naushad pointed out. So I'm just going to mention that briefly here. I like to look at things longer term, which I think makes sense. Now, if you look at this, you'll notice the number one line talks about Bitcoin. It has averaged, and over the last 10 years, a 148% annualized return. Now, it does have deep drawdowns after every 3 years of good returns. There is usually a negative year. 2022 was when we experienced a large drawdown, but it came back up. We're not back at the all-time highs, but it made a spectacular return of 155% last year. The NASDAQ historically has averaged about 17% close to 18%. And notable also is the S&P, which gives us about 10 to 12%, as Naushad mentioned earlier. For those who are the gold bugs out there, you can see gold hasn't really done a whole lot, especially in a high inflation environment, providing negative returns in 2022 and 2021 has not been very impressive, although we've started to see 2023 some kind of flows back into that space. And overall, it's just done 2.5%. So, REITs, of course, have done well historically, although last year, 2022 was not very good. 2023 was a decent year for REITs, and we expect that we can all benefit from some of that within our allocations. Bonds also have not done well. If you look at the TLT as well as the BND, this is why you might be hearing a lot of news about questioning, the role of bonds in portfolios. Because of their lack of performance. And generally, people will go for equities to gain returns and will consider bonds as stable places. But what happens when the bonds don't provide the stability? And that's the big question a lot of people are trying to understand. Should we be still allocating a big 40-50% in bonds when they haven't really held up? So it's a question I'm not looking to answer today, but something you definitely want to keep in the back of your mind. Last year, we saw that growth stocks outperformed value by 31%. This was the second biggest outperformance on record, going back to data from 1979. The first best was obviously during COVID, the 2020, where there was an outperformance of 35%. So I think, growth tends to have its day in the sun, and last year was definitely one of those. The NASDAQ, of course, also was, hitting all-time highs. And, a lot of bears were still in disbelief in the beginning of the year. When the rally happened, they were, it was being labeled as just a bear market rally. But AI, was being called as just a mania. There's no substance behind it. But, there is a lot of room and legs behind the AI narrative that is out there. And I think that it's something to watch, just like we saw the iPhone moment revolutionizing the whole, mobile space. I think that the internet, brought a lot of innovation into the whole e-commerce and other things that we're benefiting from today. So I think similarly, AI this is their moment. And if you've ever heard NVIDIA CEO talk about the role of AI and the revolution that we're about to see over the next 10 years, if you're not bullish on that, I don't know what's going to get you bullish on the AI narrative. And generative AI especially is seeing a lot of growth. So we'll look at that briefly here. Diving into the equities, I'm not going to mention all the holdings because in growth, we like to be focused on specific areas rather than trying to be overly diversified. We believe that having a higher allocation in areas that we have higher conviction can play out in our favor as we go forward. Currently, one of our top holdings is Tesla. We've been holding it for a long time, and we still believe that the opportunity is going to be massive. A lot of people, when they think of Tesla, their mind goes to cars and electric vehicles. But if you look at the S curves that are portrayed on this chart here, the EVs present the smallest potential for what Tesla represents. There is the full self-driving, the autonomous robo-taxis, as you might have heard, the energy storage, the Megapack business, which actually is the highest margin business that Tesla has currently, and then the robotics business as well. And you can see they've displayed the Optimus version 2 robot here, which can sort eggs and other things. So it's just mind-blowing the advancement that they're having in so many different areas. And on the EV front, they're really smoking every other company out there, and their growth is only just getting started, especially with all the gigafactories that are coming online and ramping up. We should see more and more Teslas as we go forward. They had the Cybertruck that is also getting released, and there's almost 2.5 million on the wait list. So exciting times ahead. With regards to equities, the other notable areas I mentioned, NVIDIA. Bank of America believes that NVIDIA could generate $100 billion in free cash flows in the next couple of years. And that's massive. I mean, the worldwide AI market we are seeing was worth about $140 billion in 2022. It is projected to hit $1.8 trillion by the year 2030. So that is a growth of about 20% per year. And the AI server market is also expected to grow. You can see generative AI is also increasing in growth. And they're going to need chips. The demand for chips is off the roof. The H100s that NVIDIA produces are selling for $30,000 a piece. And they are sold out pretty much, even if the China bans do play out. The demand is just through the roof. All the large technology companies, Microsoft, Google, Facebook, and Meta and others, they cannot get enough of these chips for all their applications. Large language models like OpenAI, they need a lot of these chips to run that. So ultimately, you want to be in the prime position, and I believe NVIDIA will continue to dominate this space for the next couple of years at least, until we see other competitors getting into the space. One of the other areas that I feel is very bullish is Bitcoin, and I'll talk a little bit about how and why. The miners, according to Econometrics research, can potentially grow 6 times faster than Bitcoin. So this year, a lot of analysts will throw different price targets out there, some very bullish, some conservative. I believe it's very much possible for us to see $80,000 to $100,000 Bitcoin price before end of this year. And if that were to happen, we could see the mining stocks, which you do have in the growth strategies. A lot of you may have seen CleanSpark, Bitfarms, among others. There's a potential for them to do a 6x. And why is Bitcoin so popular? It's a scarcity narrative. It's as one of the top reasons. We are in the beginning of this S-curve moment. The supply is declining. From the rewards of mining, we're entering a period where the supply is continuously decreasing over time while the adoption is taking off. In addition, all of these ETFs represent potential for about $27 trillion and that they're managing. And if they only take even 1% of their assets under management and put it towards this asset class, that could, there's no mathematical models that can show where the price can go because of how scarce this asset is. Just literally 2 hours ago, the SEC approved Bitcoin spot ETFs, which is considered as a milestone for the digital assets. This was something that was in the works, and literally tomorrow, a slew of them, maybe 8 or 10, are likely going to be trading as early as tomorrow. So according to Bloomberg research, they are expecting anywhere from $2 to $4 billion in the first week just flowing into the space. So I think that it's very exciting to see how this is going to play out. In this particular chart, I think the gold chart is overlaying the left chart, but Bitcoin's risk reward is off the, it's not even represented with the left bubbles that you see there. It's on the right hand side, but I think that might be covered with the gold slide. So what happened, if we wanted to get an idea, what happened when gold was approved? The gold ETF was approved in November 2004, and that ushered in a movement of assets and inflows that did not see drawdowns for 8 straight years, till 2012. So if that same analog were to apply, it's possible that Bitcoin also has an 8-year run. And that could mean we're still very early and there's a lot of opportunity ahead. And the other thing to keep in mind is Bitcoin is more transportable, more divisible, and it's digital. Gold is very heavy and it can be dug up. They've found mines just like lithium. There is gold mines that can be uncovered in many parts of the world. But Bitcoin is a fixed supply. You cannot manipulate the supply. It's fixed at 21 million. A lot of them have been lost by people who have not secured their wallets. And so, it's exciting to see where this, scarcity is going to lead to price appreciation. That's the only way this can go. Of course, there's always a 1% chance this goes to zero. So it's a risky asset class. But I think this is a new era which we are going to all see taking place as we go forward with the approval, especially this evening. Cash on the sideline. There was a lot of cash that left, was on the sidelines idle. We believe a lot of that can come back into markets, and that will be one of the catalysts for what we expect to drive the markets forward. I'm not going to go into too much detail, but as of November end of last year, there was close to $5.7 trillion on the sidelines. So you can imagine a lot of people missed the rally that took place last year. And, people will likely find that, there's opportunity to take some of that and put it into equity markets, which I think is likely going to be happening this year as well. What are the other catalysts? Well, if the US dollar is declining, and part of the reason is, there's less demand for it globally, China, Russia, among other countries are no longer relying on US dollar for trading as much as they used to. There is other BRICS currencies that you might have heard of. So as the dollar declines, that is usually positive for countries that are converting their growth in other currencies back to the dollar. The VIX has been declining, the volatility index. We've seen the lowest levels that it's been since January 2020. So lower volatility means people are more optimistic. Higher volatility means there's more fear out there. So we obviously want to balance that out. But so far, we're seeing a trend where the volatility index has been declining. Declining oil prices is very positive, especially for what we expect with regards to inflation. Inflation has been falling like a rock. We mentioned at least 3 rate cuts this year. The cash, on the sidelines coming in, and being an election year, we're currently just crossing 34 trillion in US debt, which is just crazy to just even imagine. And the deficits are close to $1 trillion. So to bridge that gap, the government is going to be forced to print more money, and more money means it lifts up all boats basically when there is more money printing. And I think stimulus and other things are probably going to be happening more this year, especially given it's an election year. So, we'll see how this plays out, but these are the catalysts we're seeing. Longer term, there is a wealth transfer taking place. Close to $68 trillion is moving hands from especially the baby boomers into the hands of the millennials and others, down the line. And that is going to be flowing primarily into Bitcoin, digital assets, and innovation. So that is very positive for a lot of the growth style of investments that we're doing. And we'll continue to monitor how the flows happen over time. But this is something that is in motion, and it's not going to happen overnight. It's going to take some years, to trickle down. But this, of course, will be positive, we believe, for equity markets, and especially innovation in particular. So what are some final thoughts here? The Federal Reserve was able to come into 2023. There's a lot of skepticism. There's a lot of fear. People were scared that, look, the yields on the 10-year Treasury were going higher, and they actually did touch a 16-year high, but the S&P still managed to go up over 20%. We believe that markets are forward-looking. So even though we might be in an environment where rates were going up, the market was anticipating a period of easing happening at some point, and that's what was, remarkable about what played out. And investors did take advantage of some of those opportunities, were rewarded. At the same time, we saw a lot of craziness, with the regional banking crisis, Silicon Valley Bank, First Republic Bank, among others, going through bankruptcies. Fear, that created fears in people's minds that, are we going to see a cascading effect with some of these regional banks kind of going under? Also, there was, war in the Middle East, debt ceiling. There was some of that we heard they had to raise that. And the Fed was raising rates. All of these were reasons that everyone cited that, what, we should be cautious. We should be on the sidelines. Let's put our money in money market funds where you earn 5% yield while we wait. And as we said earlier, do not necessarily wait too long, because sometimes you might miss some of the big gains that, obviously took place. But those who took advantage of the dips, they were definitely rewarded. Now there's concern that, this year there's geopolitical stuff going on. There's elections, exploding deficits, and there's always going to be a wall of worry out there. But it's all about trying to look ahead, and if things are not as bad as expected or better than feared, then markets tend to react more positively to that. So we believe that, there was resilience in 2023, and we're hopeful for easing conditions this year, especially with lowering of rates, more liquidity coming in, and we hope that is going to drive, hopefully, another year of double-digit returns. So with that, we want to pause here and take any questions that you might have. So someone has some questions about ETFs. Our team has done quite a stellar job, and Naushad can talk a little bit about the ETFs as well, but I see there's a question about that. I don't know if Naushad wants to tackle it. You're on mute, Naushad.
All right, thanks. I can address this question. I think one of our attendees was thinking we should have a lot more, and we would love to have a lot more ETFs. But the reality is we can only build so many because each one, it's quite a bit of work and quite a bit of money to launch these products. So what happens is a lot of times we're looking at what the banks want, and the banks are some of our biggest customers for ETFs. So like the funds that we just launched last month were actually requested by the banks, and they basically say, look, if you do this, we'll put $20 million into the fund. So for us, it's a little bit more on the reactive side, because if someone's coming to you and saying, hey, this is the product we want, and this is what we're going to put in it, we have to follow that. So it's difficult to decide which ones we want to launch next. But when you have a customer who's ready to buy, like what Aliredha was talking about, NVIDIA, their pipeline is huge. There's no problem on the customer side. It's just the supply side. So for us, it's kind of like that too. We really, we want to do all of it. We want to have all the funds that everybody wants, including, a total market fund like Vanguard's or even a high dividend paying fund. I think those are great funds to have. I would love to release them, but we have limited resources ourselves. And so we're doing it slowly because we have to. If I could launch 10 funds right now, I would. But as the communities continue to support our funds, we will definitely keep launching more. And, if there are funds that you want to see, I'm glad this particular individual today is giving us some ideas of funds that he'd like to see. I'd love to hear that from everybody. Anyone who has special requests, please reach out to us. We're listening. We've had other people who have requested high yield funds, and so that's definitely been on our radar. Total market fund is a good idea as well. So we are listening. Please reach out, info@sp-funds.com. Thank you.
Thank you for that. I think someone is referring to insurance products. Is that what that is?
IULs. I'm not familiar with IULs.
What is your thoughts on the Japanese here? Okay, I think it's insurance. What is your thoughts on the Japanese yen if Bank of Japan abandons the yield curve control? So yeah, that is one of the concerns also on the yen. If they abandon the yield curve control, starts rate hikes, that has been actually on the talks on the macro front. I do think that, some of that might be more contained. It may not be as cascading effect as that might seem. But the debt problems that we're having in the US are very minor compared to Japan. So I know too much debt is problematic, but I think it's a global problem. It's not just a Japan issue. Europe and other countries are having the same issue where there's too much debt in the system. And that is also one of the reasons why Bitcoin is getting even more popular, because people want that schmuck insurance or whatever they want to call it against debasement of fiat currencies. And of course, it's a volatile asset, so you want to be careful with that. But that's one of the proponents of that asset classes, because it's not like what the governments are doing, right? They're always on the spending spree. So hope that helps. Universal. So insurance, actually, I'll tackle that briefly. The problem is that insurance is a big opportunity, but it's also a concern. In the past, I've actually written an article about insurance in particular. It's very hard to take off because there is also the reinsurance on the back end. AIG and others faced issues with structuring things in a way that was not considered compliant. And a lot of these insurance products are not, the contracts themselves have a lot of garar, which is uncertainty, and they're not based on Sharia compliant principles. So it's very hard to structure that in this environment, but I'm sure there are ways to do this potentially and work with the regulations framework. Just like the mortgage business folks came out with products that were trying to tackle this issue in an interest-based environment. I'm sure there is opportunity in that space, but right now that's not something that we're necessarily focused on at present.
But when it comes to life insurance, I'll just chime in real quick. A lot of, even conventional investment advisors, not necessarily in the Sharia space, but in the conventional space, would advise that you technically can do quite a bit better if you were to just buy a term policy rather than having any kind of universal life insurance, because the fees are very, very heavy on those type of products. They're very expensive, and they generally work very well for insurance companies, maybe not as much for you. My personal opinion on these type of products is that it's kind of like, if you look at what's happening, it's almost kind of like you're giving the insurance company a loan. So they have your money, then they're going to go ahead and put it in all kinds of different income funds, fixed income funds, maybe even some equity. But a lot of that is happening on their side. And then you're paying them to take your money to do this, so that if anything happens to you down the line, your beneficiaries will benefit at that point. But from the little I know about the insurance space, I think it really does work out much better for people to just buy a term policy and then invest themselves and let their money work for them rather than for an insurance company. Are there any other questions?
Appreciate those that have submitted their questions. We are currently about 17 minutes off the hour, so I appreciate those who are here. I know people are going to be getting ready for Maghrib prayers soon if they haven't yet made it there. But I see a couple other questions here trickling in. Maybe I'll handle this last one, and if Naushad, you want to do any more, we can wrap it up in a couple of minutes. So any thoughts on potential political or black swan type threats associated with Bitcoin and/or Tesla? Either Bitcoin, for instance, threat of curbing China or SFP, or Elon Musk volatility. So there's always a lot of FUD, I like to call it, against Elon Musk. I know he does a lot for the world, but that also makes him a target. Whenever you are popular, whenever you are successful, I should say, you end up, creating a target on your back. But you don't want to. I would bet less against. I don't like to use the term bet, but I wouldn't necessarily consider that those are concerns. He has definitely fulfilled a lot of things with the team and the resources that he's had, and I think he's capable of making this succeed. So with Tesla, even though he may not survive, I think they have some of the best team in the world. The AI, I think everyone thinks of NVIDIA when it comes to AI, but I think personally, with all the different revenue streams and S-curves that Tesla has, is probably the #1 AI company in the world. It's going to take time maybe for Wall Street to wake up to some of that, but I do think that it creates a lot of opportunity for investors who can see what they're doing and the direction they're heading towards. So it's hard to say for sure what might happen if Elon Musk is not in the picture, but I think that there's always going to be FUD surrounding Musk all the time, and that's just the mainstream media. They're threatened by X and Twitter, so they'll always make up different things. In addition, with regards to Bitcoin, I do think that if there is a better alternative technology out there, or if there's government seizures of Bitcoin, there's always threat to that. But that's why people are encouraged self-custody. And, as you've heard, not your keys, not your coins. So, on some level, there is that aspect. On the other level, there is, those who are not comfortable self-custodying, I think are going to try and take advantage of some of the mining companies, as we've mentioned, as well as some of the ETFs. Now, I don't know what the Sharia compliance will be for the ETFs, but it's something we'll be monitoring. And that could be an on-ramp for those who do not want to take the headache of custodying their own asset and would rather have it on Schwab or any other platform that they're more comfortable with. And I think that, considering all the different tailwinds that are behind this asset, even if one were to play a small or allocate a very small portion of their portfolio to this, if it goes to zero, okay, fine. But if it does succeed, there's big gains. And you've seen the last 10 years have definitely shown resilience, and average of 140% is no joke. So I think that this is an asset class that's going to be taken even more seriously now that the marketing departments of BlackRock and Fidelity and others will start pumping this thing out there. We do feel that it's going to get more mainstream adoption. Regarding the Sharia scholar on our team, we do still work with Sheikh Umar Khan. He's on our board as our Sharia advisor. So hopefully that addresses that. I think that was the main thing. Any last comments or anything else you want to mention, Naushad?
No, I'm really excited that everybody that was able to join us today was able to be here, and anyone that wasn't, I'm sure we'll have a recording on our website. I want to say congratulations to you, Aliredha. The growth models did exceptionally well last year, and inshallah we'll continue to have some really good and exciting performance for 2024 as well. So a year from now, let's meet again and do this again, and inshallah we'll have even more people with us, and hopefully we'll have even more ETFs for our clients to choose from.
Wonderful. Thank you all again for attending, and we will be sure to send out the recording for all those who are subscribed. Otherwise, we thank you for your time. If there is any feedback you have, we're going to keep improving. This is a work in progress. And if there's any family members or anyone who you feel would be beneficial to learn more about this topic or connect with an advisor, our team is ready to meet you and connect with you and discuss your financial goals. So thank you once again. We pray everyone is safe and has a wonderful 2024. Thank you, and wassalamu alaikum wa rahmatullahi wa barakatuh.
Assalamu alaikum.